Hey team, and welcome to the Trader's Apprentice blog, episode 4, the Divergence Monster. Now, it's not really a monster in my mind. He's actually one of our best friends in trading tools. The reason for the play on the word monster is because of the confusion it causes amongst many traders, and as seen on many of Mitch's live streams. So what is convergence and divergence? Essentially, it is a relationship between the indicator or the oscillator and price action or price on our chart. To understand this, firstly, we'll go again over our indicators and oscillators that we use. We use RSI, which is the relative strength index, and we use the MACD or MACD, moving average convergence divergence. The relative strength index, developed by Mr. Wilder, is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100, and traditionally, the RSI is considered overbought when above 70 and oversold when below 30, as well as a number of other strategies that can be used we'll talk about. The derivation or equation for the RSI is shown on the screen in front of us here. We're not going to go through that. It really has no bearing on what we do. We just need to understand that it is a momentum indicator and how to perceive it. Now, there are many combinations of strategies that use the RSI. It's a very useful and flexible oscillator. So it can be used for determining overbought and oversold conditions, divergence, which is the topic of this video, failure swings, and trend determination. So showing strength of the current trend, whether it's bullish between 40 and 90 and bearish between 10 to 60. Now I'll quickly show you what they mean by failure swings. When you have a look at the RSI compared to price action, you can typically find points where the RSI lines up on a particular swing, okay, or change in price. Now that's not always in oversold or overbought conditions. You can see areas within the RSI which may show swings. So it's not a strategy we use, and I don't really have a lot of experience with it, but there are many traders that look for turning points in the RSI that may show turning points in the price action above, okay? So moving average convergence divergence, MACD, is a trend following momentum indicator that shows the relationship between two moving averages. The MACD is made up of the MACD line, the signal line, and the histogram. The MACD line is the difference between the 12 and 26 EMAs. That's exponential moving average, not simple. And the signal line is the 9-period moving average of the MACD line. The histogram is the difference between the MACD and signal lines. So going back to our chart, what you'll typically see out of the box are these indicators like this. And the next question you ask is why we remove them. So as I said previously, the blue line here is your MACD line. The orange line is the signal line, and we don't use either of them. We use the histogram. So why can we only see the histogram on our charts? Well, essentially the histogram is a far more sensitive indicator of momentum change. The MACD line is simply the fanning effect of the EMAs, which is where they get the term convergence and divergence in terms of the MACD title description. And the histogram, being a fourth order derivative of price, as explained in my previous video, is far more sensitive and shows momentum changing or turning a little bit sooner than using the MACD line alone. Again, hit me up in Discord if you didn't quite or don't quite understand that, or go back to my my charting and trading view video to have a look at that again. So what is convergence? Convergence is when you have, I guess, agreement of the indicator and price. So we have, in this case here, a high and a higher high, and we have momentum building from a high to a higher high. So momentum is converging or moving with price. Okay, it is increasing as price is increasing. That's shown on the MACD here and also on the RSI. When you're in a strong trend, that is exactly what you want to see. Your higher highs with higher momentum in your indicators, oscillators. So divergence and its many forms, and this is where it starts to get a little bit confusing for everyone, okay? Firstly, Class A bearish divergence. In this example here, we have high, higher high, and further higher high. But as you can see in our MACD here, our momentum is dropping off, forming a high, a lower high, and even lower high again. So we are having the price action moving opposite to our momentum, therefore diverging. The RSI shows the same thing. I'm sorry the middle high wasn't perfect. I didn't quite get a perfect example, but you can see that between the first and last lower high here, it is moving away from the price action, okay? Ironically, the example that you see here in front of you, I believe I pulled from the daily Bitcoin in December when it reached all-time highs. So if you were watching these indicators as price was going parabolic and crazy, you would start to question on this third high what to do with your trade or your Bitcoin if you had seen this on the chart, okay? Now the second case I want to show here is Class B bearish divergence. This is where you essentially double top on price. So prices seem to be even. This is probably the best example I could find for this video, sorry. But again, you see the same thing with the oscillators. Okay, as the price moved to its first high, there was good momentum behind it. But as it moved to its second equivalent high, you had far significantly less momentum shown in your indicators, and that's both on the RSI and the MACD. That is Class B bearish divergence. So equal tops in price, we still have lower momentum in our indicators. Next up, we have Class C bearish divergence. In this case, it is the weakest form, as Mitch will say many times in videos, and you can see in this example, while we had it on the MACD, we didn't have it on the RSI, and price did continue for some time before it pulled back. You'll see that there's probably Class A bearish divergence going on here, which is probably more the reason for the pullback. But just for the example, I just want to show you what it would look like. You would see a higher high, but equivalent or equal momentum in your oscillators and indicators. I couldn't find an example where they lined up both the RSI and the MACD there, I'm sorry. Now I've shown you the Class A, B and C bearish divergence. Bullish divergence is the absolute inverse of this. So when you see lower lows and you're not seeing the same lower lows on your indicators, but just to keep this video concise and shorter than the previous videos, I didn't want to include full descriptions for that. So just when we thought we were beginning to understand divergence, we now throw in hidden divergence. Again, mentioned briefly and not too often in our streams and videos and things. It's similar to Class C, it's a weaker form, but let me run you through it quickly, okay? So you have a push to a higher high in price, and you have another push or a surge, but you don't quite get equivalent or higher highs, you get a lower high. But that happens or occurs when the momentum is high and trying to push that price up but doesn't succeed. So you have a lower high on price, but you actually have a higher high in your momentum indicators. This is called hidden divergence because the momentum is strong and behind that trend, but you just simply cannot get the price. So therefore, that is called hidden divergence, and technically it tends to result in a change or a reversal in price temporarily at least. Okay, that's hidden divergence. And again, there is class A, B, and C, which I'll show you shortly. So I'm going to include this cheat sheet for you all as an attachment to the video, which shows you divergence class A, B, and C for both bearish and bullish cases. And it also shows the hidden divergence class A, B, and C. Now, I wouldn't go chasing or hunting hidden divergence too much, but simply focus on the pure forms of divergence here. Okay, I hope that's clear for you guys, and the attachment will be in the Patreon with this video. So look, I'll keep this one nice and short for you guys. Feel free to hit me up in Discord if you have any questions or want me to cover anything in more detail or one-on-one. Happy to do that too, okay? Again, just lastly, if you want to show any appreciation for these video blogs and you're finding them, you're really getting a lot of good information out of them, you're welcome to hit me up on Discord for a Bitcoin address or some other means to tip or show any appreciation. However, as always, a thank you or a kind bit of feedback will be enough, okay? Nice short one for you guys, and we'll be back next time with, I believe, my charting Excel sheet, which will be a nice little giveaway for you guys. Thanks very much. See you next episode, guys. Ta-ta.